Subprime Loans chain collapse global response. Hey everyone, welcome back. September 15, 2008. Lehman Brothers, one of the largest and oldest investment banks in the United States, founded in 1850, surviving the Civil War, 2 World Wars, and the Great Depression, filed for bankruptcy. $613 billion in debt. The largest corporate bankruptcy in American history. The next morning, global financial markets began to collapse. Credit markets froze. Banks stopped lending to each other. The machinery of the global financial system, the plumbing through which money flows to businesses, governments, and households around the world, seized up. Why did the failure of one institution trigger a global catastrophe? The answer lies in a financial engineering system so complex that almost no one fully understood what it had built, or how fragile it was. Today we're going to walk through the full story. The subprime mortgage time bomb, the chain reaction that spread it worldwide, the desperate government interventions that prevented an outright depression, and the lessons, learned and unlearned, that the crisis left behind. To understand the 2008 crisis, you need to understand the housing bubble that preceded it, and the financial machinery that inflated it. In the early 2000s, U.S. house prices were rising steadily, and the belief that real estate always goes up had become something close to a cultural religion. Low interest rates following the dot-com crash and 9/11 made borrowing cheap. And demand for mortgage-backed assets from institutional investors around the world was enormous. Into this environment came the expansion of subprime lending. Subprime refers to borrowers with lower credit quality, unstable income, poor credit histories, limited documentation of their finances. Under normal circumstances, banks don't lend to subprime borrowers because the risk of default is too high. But the early 2000s were not normal circumstances. The reason banks abandoned their lending standards comes down to one structural fact. They weren't keeping the loans. The model had changed from originate and hold to originate and distribute. Here's how it worked. A mortgage broker makes a loan to a subprime borrower. The broker sells that loan to a bank. The bank bundles thousands of similar loans together and issues a security, a mortgage-backed security, or MBS, backed by the cash flows from those mortgages. The bank sells the MBS to investors. The risk has been passed on. The bank made its fees and moved on. The broker made commissions on volume. Neither has any incentive to care whether the underlying borrower can actually repay. Then came the next layer of complexity. CDOs, or collateralized debt obligations. Banks took slices of multiple MBS products and bundled them into new securities. Through the mathematical magic of tranching, the idea that even if some borrowers default, the senior layers of the CDO remain safe, these products received AAA credit ratings from Moody's, S&P, and Fitch. AAA. The highest rating available. Supposedly as safe as U.S. Treasury bonds. Pension funds, insurance companies, and banks around the world bought them eagerly. They offered higher yields than treasuries with supposedly equivalent safety. What they actually contained was concentrated exposure to millions of American subprime mortgages, risks that the ratings models had systematically underestimated. When U.S. house prices peaked in 2006 and began to fall, subprime borrowers, many of whom had been given loans they never realistically could repay, began defaulting in large numbers. The carefully constructed mathematical assumptions underpinning the CDOs began to fall apart. The bomb had been built. And now its fuse was lit. The warning signals came in 2007. Subprime lenders began failing. In August 2007, BNP Paribas, France's largest bank, froze 3 investment funds, saying it could no longer value their assets because the U.S. subprime market had evaporated. Many historians mark this as the first moment the crisis became visible to the world. In March 2008, Bear Stearns, one of Wall Street's most storied investment banks, collapsed in a matter of days. Bear was heavily exposed to mortgage-backed securities. When rumors of its fragility spread, the short-term funding markets it depended on to operate overnight closed to it. The Fed brokered a rescue sale to JP Chase at $2 a share, a company that had been worth $170 a share a year earlier. But the moment that truly changed everything was September 15, 2008. That weekend, Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke had tried to organize a private sector rescue of Lehman Brothers, the way Bear had been rescued. It didn't happen. Lehman filed for bankruptcy at 1:45 in the morning. The effect was immediate and catastrophic. Lehman had counterparty relationships with virtually every major financial institution in the world. When it failed, those institutions didn't know how much they were exposed. And because they didn't know about themselves, or about each other, they stopped trusting anyone. The interbank lending market, where banks lend to each other overnight to manage their daily cash needs, froze almost completely. The LIBOR-OIS spread, a measure of banking stress, spiked to levels never seen before. A money market fund broke the buck, falling below $1 per share, triggering a panic among retail investors who had assumed money market funds were as safe as cash. The credit crunch, the sudden contraction of credit flowing through the financial system, hit the real economy with devastating speed. Companies that depended on short-term commercial paper to fund their payrolls and inventory couldn't borrow. Car sales collapsed. Manufacturers stopped ordering. Unemployment began rising with terrifying speed. The contagion spread globally. European banks had been major buyers of American CDOs. Belgian-French bank Dexia, British bank Bradford and Bingley, German bank Hypo Real Estate, all required emergency rescues. Iceland's entire banking system effectively collapsed, requiring an IMF bailout of the country itself. By the end of 2008, major global stock markets had fallen 40 to 50%. World GDP shrank in 2009 for the first time since World War II. Tens of millions of people lost their jobs. The policy response to the 2008 crisis was unprecedented in scale, speed, and, to many observers, moral hazard. In the United States, the first major intervention was TARP, the Troubled Asset Relief Program. Passed by Congress in October 2008 after an initial failed vote that sent markets plunging even further, TARP authorized $700 billion to purchase troubled assets from financial institutions and inject capital directly into banks. The government effectively became a major shareholder in institutions including Citigroup, Bank of America, and AIG. AIG deserves special attention. The insurance giant had written enormous quantities of credit default swaps, effectively insurance policies on CDOs, without holding the capital to pay out if the CDOs failed. When they failed, AIG owed money it didn't have to virtually every major financial institution in the world. The government provided an $85 billion bailout, later expanded, because allowing AIG to fail would have triggered losses simultaneously at banks across the entire global system. The Federal Reserve under Ben Bernanke moved with equal aggression. The Fed cut rates to near zero and then went further. It launched quantitative easing, directly purchasing mortgage-backed securities and treasury bonds to inject liquidity into frozen markets. The Fed's balance sheet expanded from roughly $900 billion before the crisis to over $4 trillion in its aftermath. Bernanke was a scholar of the Great Depression who had argued in his academic work that the Fed's failure to provide liquidity in the 1930s had turned a recession into a catastrophe. He was determined not to repeat that mistake. In 2022, he was awarded the Nobel Prize in Economics partly for this crisis management. In Europe, governments moved to rescue their banks. The UK nationalised Northern Rock and took controlling stakes in Royal Bank of Scotland and Lloyds. Germany, France, and Belgium recapitalised their major banks. The EU established emergency liquidity facilities. The ECB cut rates and provided long-term loans to European banks. Internationally, the G20, which had previously been a forum for finance ministers, was elevated to a leaders' summit for the first time in November 2008. Major economies coordinated fiscal stimulus. China launched a massive $586 billion infrastructure program. The US passed an $800 billion stimulus package under the Obama administration in early 2009. The coordinated response worked, in the narrow sense that the global financial system did not collapse and the world did not experience a repeat of the 1930s depression. GDP fell sharply but recovered. Credit began flowing again. The macroeconomic numbers of the 2008 crisis are large enough to become abstract. Let's make them concrete. Approximately $30 trillion in global stock market wealth was destroyed in 2008 alone, roughly equivalent to the entire annual economic output of the United States, China, Japan, and Germany combined. In the United States, more than 8 million jobs were lost. Unemployment peaked at 10%. Approximately 3.8 million homes were foreclosed between 2007 and 2010, families evicted from homes they had bought in good faith, often with mortgage products they hadn't fully understood. For many working-class and middle-class Americans, the crisis destroyed retirement savings. For 401k accounts that had taken decades to build were cut in half. For younger workers entering the labor market between 2008 and 2012, the scarring effects on lifetime earnings have been documented by economists. The Great Recession cohort earned less, on average, than comparable cohorts for years afterward. Meanwhile, the financial institutions responsible for the crisis were rescued. Their executives, in many cases, continued to receive substantial bonuses. Not a single senior Wall Street executive went to prison for conduct related to the crisis, though the conduct that led to it was, at minimum, reckless and in many cases arguably fraudulent. This disparity, the socialization of losses and the privatization of gains, generated a political anger that has not fully dissipated. The Occupy Wall Street movement of 2011, the rise of economic populism on both the left and right, and the electoral disruptions of the mid-2010s in the US and Europe are all, in some measure, traceable to the unresolved grievances of 2008. What did the 2008 crisis teach us? And what have we failed to learn? The first lesson. Complexity hides risk. CDOs were sold as products that distributed and managed risk. In practice, they concentrated risk in ways that were opaque to buyers, regulators, and often to the sellers themselves. A financial system where no single participant understands the aggregate risk exposure of the system is a system primed for catastrophic failure. The second lesson. Misaligned incentives generate systemic risk. Mortgage brokers were paid on volume, not quality. Banks earned fees for originating and distributing, not for the long-term performance of the loans. Rating agencies were paid by the issuers whose products they rated, a conflict of interest so fundamental it is difficult to understand how it was tolerated. When the people making decisions are insulated from the consequences of those decisions, bad decisions accumulate until they become a crisis. The third lesson, and the most politically contentious, is the too big to fail problem. The implicit guarantee that systemically important financial institutions will be rescued creates precisely the moral hazard it's supposed to prevent. If you can't fail, you have incentives to take more risk. The Dodd-Frank Act of 2010 attempted to address this through higher capital requirements, stress tests, and resolution mechanisms. Whether it succeeded is still debated, and significant portions of the act were rolled back in 2018. The fourth lesson is the importance of international coordination. The 2008 crisis was global, and the response, however imperfect, required global coordination. The G20 framework established during the crisis has become a permanent feature of international economic governance. The alternative, every country responding independently in a race to protect its own banks, would likely have produced a far worse outcome. What has not been fully learned? The political economy of financial regulation. The financial industry's lobbying power is structural and persistent. Regulations get written, then softened, then watered down over cycles. The underlying incentives, short-term profits, fee generation, competitive pressure, that produced the 2008 crisis are still present. The next crisis will likely look different. But it will emerge from the same fundamental dynamics. Leverage, complexity, and the gap between who takes the risk and who bears the consequences. The 2008 financial crisis was not an act of God or a random market fluctuation. It was the product of specific human decisions. To lend recklessly, to package that recklessness into complex instruments whose risks no one fully understood, to rate those instruments AAA when they were not, and to build a financial system so deeply interconnected that when one major node failed, the entire network shook. The policy response, unprecedented in scale and largely successful in preventing a second Great Depression, nonetheless left deep wounds. In the lives of millions of families who lost jobs and homes, and in the political fabric of democracies that watched financial institutions get rescued while ordinary citizens paid the price. The crisis is now 16 years behind us. Memories fade. Regulations soften. Incentives reassert themselves. Whether we have genuinely learned from 2008, or merely recovered from it and moved on, is one of the most important open questions in global finance. Understanding what happened, and why, is the best protection any of us has. The next crisis will come. It always does. The question is whether we're looking at the right things when it arrives. Thanks for watching. If this was useful, a subscribe and like helps a great deal. See you next time. Approximate 2,800 words / at 140 words / min. 9:50 10:10. Don't miss the next episode. Subscribe to the channel and hit the bell.